The sordid history of the home equity line. Whew, there's some ugly stuff here, my friends, and I don't know how these people go to bed at night, but be that as it may. All right, so I'm reading a South Carolina law review from spring of 2000 from this lady, Kathy Lesser Mansfield. The road to subprime hell was paved with good congressional intentions. Usury deregulation in the subprime home equity market. Now we're going to get into subprime stuff here because we don't even need to go into subprime to realize the evilness and just disgusting nature of how this came to be. But be it as it may, we're living this now. So you might be wondering how I came across this. Well, I'm reading this book that my mom sent me about a year or 2 years ago called The Two Income Trap: Why Middle-Class Mothers and Fathers Are Going Broke. And who's the author of this? Oh, one, Miss Elizabeth Warren, pre-senator days, with her daughter Abigail. And there's Elizabeth Warren when she still claimed to be a American Indian. All right, anyway, so we're going to talk real quick about, we're going to set up the premise here and how much the bankers control everybody. It's crazy. In 1998, Hillary Clinton was a star attraction at a Boston fundraiser to support women's issues. Nancy Pelosi and Sheila Jackson Lee were there. It was going to be great. Miss Clinton was in her element in front of this mostly woman audience. She was hard-hitting and vibrant. I stood there waiting in the darkened hallway in a service entrance. I had been invited to meet Miss Clinton because it turns out she saw an op-ed I had written in the New York Times about women and bankruptcy. A few weeks earlier, I had written a column that sharply criticized a bill that was making its way through Congress that proposed to undercut bankruptcy protections for middle-class families in trouble. And Miss Clinton, at the end of the discussion, Miss Clinton said, "I'm convinced it's our job to stop that awful bill." And her newfound opposition to the bankruptcy bill surprised me. But President Clinton's staff had been secretly supporting the bankruptcy bill for several months. Clinton wanted to show that he and other Democrats were new Democrats and could play ball with business interests, i.e., were open to the largest bidders. All right, so long story short, Hillary Clinton was able to get this bill vetoed. So Clinton vetoed it. On the way out, President Clinton. Wait one second. Right, hold on. Let me see here right quick. I think he vetoed. In October 2000, Clinton vetoed the bill. In the following summer, an aide explained to me the abrupt about face. A couple days after Miss Clinton met with you, we changed sides on the bill. And so thanks to Miss Clinton, we were able to get that bill defeated. All right. But the story doesn't end there. The banking lobbyists were persistent. President Clinton was on his way out, and credit card giant MBNA emerged as the single biggest contributor to President Bush. In the spring of 2001, and again, the Republicans controlled at least the House. Did they have the 50-50 split in the Senate? I can't remember. But they were basically in control of all three branches. Well, not branches, but the Congress and the executive. In 2001, the bankruptcy bill was reintroduced in the Senate, essentially unchanged from the year before. But this time, Hillary Clinton, a new senator, voted for it. Had the bill been transformed to get rid of the awful provisions that had so bothered Hillary Clinton when I met with her? No. The bill was essentially the same, but Hillary Clinton was not. As First Lady, she had been persuaded that the bill was families. All right? But as New York's newest senator, it seems that Hillary Clinton could not afford such a principled opposition. Campaigns cost money. And money wasn't coming from families in financial trouble. Senator Clinton received $140,000 in campaign contributions from the banking industry in a single year, making her one of the two top recipients in the Senate. All right, so there you go. So this is a bipartisan issue here for sure. The banks pay to get rich. And that's what they do. So we're going to talk about this. We're going to go to the conclusion first. Hold on just a second, because I want to show. Going back to 2000, whether at the state level or the federal level, subprime borrowers clearly need the help of regulators in curbing abusive practices, ad hoc pricing, and unaffordably high rates. From 1933 until 1979, mortgage loan rates abuse was prevented by rate ceilings imposed at the federal level for some loans and at the state for others. Such ceilings still exist at the state level for many kind of consumer loans. But she keeps talking about the subprime. It's not just a subprime. The home equity market that has developed in the absence of mortgage loan rate regulation demonstrates that justification for rate limits still apply. All right, so I want to go into the very beginning of this because it's nuts, man. Basically what was happening is that the interest rates are going sky high because of the inflation, because we have to whip inflation now. And oddly, it didn't really whip inflation until 1982. Strange how high interest rates didn't actually beat inflation. Now, what was happening, though, is that mortgage rates were regulated by the states. And the states, a lot of these states, Texas and Arkansas, but all kinds of states had usury. You could not loan out more than 10% on a mortgage. Your first mortgage could not be more than 10%, or your mortgage could not be more than 10%. That's what you could not charge more than that if you're a lending institution. Well, guess what? The banks themselves had to pay more than 10% for the money in which to loan you at 10%. So the theory is no one's going to do loans in the states with usury laws, Arkansas, Texas, because if they have to go out to the market to borrow themselves at 12 and they can only loan to you at 10, there's a net loss. They're not going to do that. And so senators are saying we've got to be able to create more lending because we can't have farmers and middle-class people. They have no access to funds. So check this out. Here, in January of 1979, with conventional mortgage rates at a little bit over 10%, VA rates at 9.5%, and a home state constitutional usury cap at 10%, Republican congressman from Arkansas introduced a House of Representative Bill 411. It provided that constitutional and only constitutional state usury limits would not apply to loans guaranteed or made by the VA. The bill also provided that preemption contained in the bill would remain effective until an effective state adopted a new statute specifically limiting the amount of interest that could be charged on VA loans. All right, so what? Once again, as with the 1976 preemption directed at California, the effect of this bill's passage would have been to put the power to determine usury rates in the hands of the state legislature without state constitutional restraints. So what was happening is states had literally constitutional amendments that says you couldn't do anything. You had to rewrite your constitution to get rid of the usury laws. And California, a few years previously, was unable to do that. And so the bill before Congress now says, no, we're not going to allow any of that. Now, if the states wants to go back and recreate the usury laws by statute, legislative issue, that's fine. But they're not going to be able to do it by a constitutional muster. We're going to wipe the slate clean for the state legislature. And if they want to go back and reissue usury laws by statute, which can be changed by future legislation, we will let that happen. Today, by the time the bill emerged from the committee, VA rates had been increased to 10%, right at the Arkansas usury limits. The committee issued a report clarifying that the bill was intended specifically to address Arkansas. The report also emphasized that Arkansas would be the only state affected by the bill. All right? And then on June, it passed with little debate and no opposition, except for Henry Gonzalez, who worried about the Congress was authorizing exorbitant and usurious interest rates. Let's check it out. Also in May of 1979, other representatives introduced another House of Representatives bill that state usury laws, whether statutory or constitutional, would not apply to FHA loans. An identical measure was introduced in the Senate. Both bills permitted states, not just Arkansas now, to override the federal preemption by adopting statute regulating FHA rates. Okay. All right, in its report to the Senate Committee on Banking indicated that the preemption was necessary because state usury laws were limiting access to FHA programs for low and moderate income families. Interesting. That's what we always say. Well, the poor aren't getting access to money. During debate on the Senate bill, Senator Robert Morgan of North Carolina introduced an amendment to strike the usury preemption provision that you can't preempt a state law. His opposition was based on federalism, all right, because he's like, look, the state wants to put it in there, they can. But other senators disagreed, believing that because state usury limits had paralyzed mortgage lending and affected the FHA, this was an appropriate issue for the federal government. Senator Pryor advocated the need to act immediately because states such as Arkansas did not have time, given the cumbersome constitutional amendment process, to remedy the interest rate situation quickly, though. Some senators believed that if Congress did not act, there'd be a financial crisis in states that had a usury ceiling. Federalism concerns did not bother other senators because states had the right to reenact their own usury limits after the adoption of the bill. Even if you already had limits in there, we're going to get rid of them, but you can come back. Ultimately, the amendment was defeated to strike the usury preemption was defeated 62-20. All right, so anyway, long story short, let's keep going here. Ultimately, the VA preemption provision, preempting both statutory and constitutional usury limits and tying VA preemption to FHA preemption, was adopted by Congress. So basically, if there's a federal government loan, you can't have preemption. The federal government dictates that the state has to wipe clean any usury limits on interest rates. That's what they're saying. Now, again, the state could go back around and by statute say we're going to re-bring our usury limits in there, but no state did that, of course. All right, let's keep going now because it's actually pretty funny what happens. So the combined effect of the preemption of state usury ceilings was to remove any cap on interest rates for FHA or VA loan interest rates. Such rates are now set without regulation, except in states that adopted usury limits applicable to the VA and FHA mortgage, and I don't know if anyone has. But the third and final mortgage rate preemption was adopted in 1979 by Congress as well, called the Depository Institutions Deregulation and Monetary Control Act, DIDMCA. This statute is far more reaching, or much more far-reaching than the FHA VA preemptions in scope. It is exactly the statute that ultimately set the stage for I'm going to say again, the home equity lending industry of today. All right, so check this out. Benefit, and this received little attention, kind of like the 401k, received little attention when I think it was ERISA that came out. The benefit of the usury preemption, again, we're getting rid of states mandating usury laws, essentially. Now, they can go back and redo it, but not very many states did, if any. The benefit of the usury preemption was extended to any mortgage lender making more than $1 million worth of loans per year, whether the lender was a deposit institution or not. You hearing that? All right. The benefit of the usury preemption was extended to any mortgage lender making more than $1 million of loans per year, whether they were an FDIC deposit institution or not. In some places of the debate, it seems as if certain members of Congress were unaware of this fact. In other places, only brief references are made to the impact this legislation would have on loans made by non-depository mortgage lenders. Second, although the debate focused entirely on purchase money home mortgages, the preemption apparently extended to any mortgage secured by the first lien on residential real property. Thus, Congress failed to make any distinction between purchase money loans or other home secured loans. So a purchase money loan is literally, I'm going to buy a house. I'm using this loan to buy a house. What is the loan for? To purchase that house. A home equity line on a house you're already in isn't a purchase loan. It's not, because you're already in it. You see what I'm saying? So now they've got rid of the people who can make these loans. Anyone can. Non-depository institutions, as long as they make over $1 million, they are basically null and void of any usury limitations set by the state. On top of that, it doesn't have to be money to go buy a home, which is the whole point in Arkansas and these other states. They didn't have enough money to go purchase a home and loans because of usury laws. Interesting, huh? Talk about the law of unintended consequence. During the entire debate in the Senate, no one even considered setting a national usury limit rather than simply preempting states. Furthermore, there is virtually no discussion on what might prevent a covered lender, anyone who has over $1 million in loans for mortgages, from charging predatory rates once state limits were preempted, except for one reference to rates being controlled by the market and two references to the bill relying on market forces rather than regulation. All right. So on March 21st, 1980, the permanent version of DIDMCA was passed. So let's check this out. Consequently, the permanent preemption became effective April 1st, 1980. So once Congress got the mitts on that, and 2 years later, Congress adopted another preemption. It adopted the Alternative Mortgage Transaction Parity. It prevents state statutes restricting the use of alternative mortgage transactions, such as variable interest rate loans, balloon payments, and negative amortization, and any loan or credit sale secured by an interest in the residential real property that is made, purchased, or enforced by a covered lender. Why did they do this? Because increasingly volatile and dynamic changes in interest rates seriously impaired the ability of housing creditors to provide consumers with fixed-term, fixed-rate credit secured by the interest in real property. All right, so they want to help people get access to money. I thought we preempted it. I thought that was going to solve all that. All right, but check this out. All right, it didn't take long until was adopted for some second mortgage lenders and other lenders who had been making high-cost consumer loans to notice that this new law appeared to allow them to charge an unlimited amount of interest provided they took a first lien on the borrower's home. Thus, a number of lenders who would not otherwise made first lien home equity loans before this law began to cast car loans, small consumer loans, and second mortgage loans, as well as very expensive home equity first lien. So your lien. All right, so I got a mortgage, a first mortgage on this house, and I have a second mortgage, both with Penn Fed. So my second mortgage is a second lien, and my first mortgage is a first lien. All right, so a lot of times if you have a first mortgage with Penn Fed, and then you get a second mortgage with Navy Federal, Penn Fed would have to subordinate, or Navy Federal would have to, or if you want to refinance your first, it's called subordination. Basically, what happens is the first lien gets paid first. That's just all there is to it. They're more secure of the debt holder. The second lien is less secure. They're like second mortgage is always going to be subordinate to the first. So if I'm refinancing my first mortgage, but I want to keep my Navy Federal second mortgage, I got to get Navy Federal to agree to subordinate themselves to continue to be second in charge relative to the first, which would be, again, my new first mortgage company. I hope that makes sense. Second mortgage always has less, there's more risk to the second mortgagee. All right, let's keep going. So again, what's happening now is you got non-depository institutions and other institutions beginning to cast car loans, small consumer loans, and second mortgages as very expensive home equity first liens. Remember, it had to be first lien. It had to be by a company that issued over $1 million in loans, and that's it, even if it's not for purchase, just debt consolidation. The case of Laubach versus Fidelity Consumer Discount provides an example of this practice. In Laubach, 5 customers of Fidelity Consumer Discount Company sued the non-depository institution, non-FDIC, for violating Pennsylvania's usury law. Mr. Smith's trouble began in December of 1983 while shopping for a used car. In order to obtain a loan to pay for the car, he was referred by the dealership to Fidelity. Not Fidelity Investments that the Johnsons own. This is another Fidelity. Fidelity informed the car dealership it would not be able to make the loan unless Mr. Herbert's 80-year-old mom, Annabelle, agreed to co-sign the loan and secure it with her house. Miss Smith had owned her home since 1955, and it was free of unpaid liens. Fidelity ultimately visited the Smiths at their home, made them a loan for the amount of $2,300 for the car, and took a mortgage, i.e. a first lien. All right, the first lien was then canceled after Herbert had trouble with the car. However, they continued to pursue a relationship with the Smiths, and they offered him a $7,500 line of credit secured by the home. In January 1984, they made the Smiths another loan for $5,500, of which the Smiths used $4,200 of. Along with this amount, they sold credit life insurance of $154, and charged them even for discharging liens that had been paid but were still recorded on the property. They got charged for that. They charged the Smiths an annual rate of $36.57, claiming that Pennsylvania's usury statutes were preempted because DIDMCA had taken first position on the Smiths' property. If Fidelity had written the Smiths car loan as a standard consumer rate loan, it could have an annual interest rate of no more than 24%. If Fidelity had written a second consumer loan as a loan without taking a mortgage, it would have been capped at 24%. Additionally, because the loan was secured by Miss Smith's home, they were charged an origination fee, which one could not expect to see in a car loan, and other fees that totaled $275 associated with the title of the house. These fees would not have been present if the loans had not been written. We go back to John Copland, who could not even read or write, and he secured a car loan with a mortgage on his home, which he owned free and clear since 1957. And his interest rate, 41%. All right? And he was charged a $1,000 origination fee, 20% of the initial loan proceeds, and 91 charges and fees for recording lien documents. All right, so let's go down. The Tito Manners experience follows a similar pattern. He was in 1986 shopping for a car. They would need a co-signer for his loan. His aunt agreed to co-sign for the car. The car passed. The application went to Fidelity. Mr. Manor and his aunt were driven by an employee of the car dealership to Fidelity offices to sign the documents. They took a first mortgage of 36.6% was the interest, far in excess of the state's usury limit. Fidelity also took a $544 origination fee, about 15% of the loan. None of the borrowers would have been permitted to take loans from Fidelity without giving a first lien security on the home. So it seems that Fidelity was using the law as a device to get around Pennsylvania's usury limits. The Arkansas Supreme Court got involved, and ultimately they came to heel. But one of the issues raised by the dissenting judges was whether lenders making $1 million in loans are making federally related loans simply by taking a first lien on land and property. In the dissenting judge's opinion, if taking a lien on local land by a local lender who makes $1 million in local mortgage loans was federally related, then brushing your teeth is federally related as well, 100%. So basically what's happening here is they're saying, man, you're not even using the money to buy a house. The whole point of this was that you're going to get a mortgage to buy a home. You're just consolidating debt, calling it a lien, and because you're and taking a lien on the property and being able to get around usury laws. And because you took the lien on the property, guess what? You can do that. And because you have more than $1 million outstanding, you don't even have to be a depository institution. It's crazy. All gets worse. Initially, the Pennsylvania court held that Fidelity had violated Pennsylvania's usury statute. However, in a subsequent opinion, they reversed themselves by essentially adopting the opinion of the dissent on the original. In this new opinion, the court found that the first lien preemption applied to all first lien loans and that this was consistent with a literal reading of the statute. They didn't have to interpret. It says literally applies to all first liens. They also found this interpretation advances one of Congress's stated purposes, increasing the ability of the financial institutions to pay market rates of interest to depositors. Oh, it's going to get better, though. We're only beginning. All right, let's see. Right here, hold on a sec. So by the time the law was adopted, inflation that had pushed up the interest rates had also pushed up property values. So this led to a large untapped security pool for lenders, and lending secured by home equity became more popular. However, as interest rates soared in the early 80s and the country was in a recession, consumer borrowing dropped significantly. And home equity did not increase significantly from 1980, essentially when it came into adoption, until 1986. But what happened in 1986? Oh, the Tax Reform Act in 1986. Which disallowed the deductibility of consumer loans but permitted taxpayers to deduct interest paid on loans secured by your principal residence. This deductibility encouraged increasing home equity lending as a preferred method of consumer borrowing. These tax changes, coupled with untapped equity that could be used to secure loans and aggressive promotion by home equity lenders, spurred a tremendous increase in consumer home equity borrowing in the late 1980s. Thus, by the second part of 1988, 11% of homeowners had a home equity loan, a percentage that was up from 6.8% in 1983. Of these home equity loans, 64% of traditional home equities have been made since 1986. In dollar amounts, this meant that home equity loans grew from basically zero to $40 billion by the end of 1986. By the end of 1980, let's see, at the second time, second mortgage indebtedness. So now again, we're not just talking first liens, we're talking second liens as well. Grew to $150 billion by 1986. By the 1988, though, home equity loans were between $135 and $190 billion. So it went up from basically zero in 1980 to $40 billion in 1986 to almost $150 billion in 1988. Yeah. By 1994, 13% of homeowners had home equity debt totaling $255 billion. That's good times. Anyway, so there you go. So what's happening here is that we're starting to see not only are people taking on debt, more and more non-deposit institutions are coming into being. It's crazy. In fact, I think she's 1977 non-depository mortgage lenders such as finance and mortgage companies lent only 1% of all home loans. All right. However, by 1989, they made 32% of all home equity loans. Yikes. That's by 1994, finance companies held $40 billion of outstanding debt on traditional loans. By 1995, finance companies held 21% of all outstanding family debt. Do you hear what I'm saying? So by 1994, they had $40 billion of home equity loans. By 1995, they had 21% of all the debt. But by 1996, there are 1,250 non-depository financial institutions in the United States, although the market share of the industry is concentrated in the top 20 firms. The rapid growth continued between 1996 and 1997, with loans to individual homeowners growing at a 27% clip. Crazy. I mean, and it doesn't include mortgage banking companies that finance their lending through securitization, selling them. Yeah. Anyway, so there you go. So the whole thing is just a cluster. And again, no good deed goes unpunished, but that is a sordid history. And then she goes into the subprime thing. And I'm just telling you, man, the best way to avoid getting screwed by the bankers is not deal with the bankers, which includes reverse mortgages. I'm not gonna lie, that's my big concern about reverse mortgages. What if you don't know what you don't know? You know what I'm saying? I mean, I get it, but a lot, the facts are bankers, they have one reason only: to get you to borrow the money. They get paid commission, or they get to keep their job. And they don't get to keep their job if they decline you. They get to keep their job if they give you money. And that's a sordid history of the home equity loans. Good article. I'll put it in the show notes. We'll see you. I love your thoughts.